Yeah, hi. Good evening, everyone. Thank you for making time on this webinar. You will recollect the last time we did our webinar in October. We managed to do that in October by the skin of our teeth. 5 o'clock to be precise is when we ended on the 31st. So we thought we'll try and improve. We also have a vested interest, to be frank with you. We have a product that sits in those categories that one would call unexciting, but when one looks at last 1 year returns, etc., where customers are like, where is the positive 15% return and stuff like that, suddenly products like fixed income and multi-asset have become somewhat more relevant. But before I get into the NFO, and I promise you that's not going to be a very long presentation. More time will be taken by Rahul and Krishna, because I think there are some very interesting events that have happened in the 20 days since we spoke, particularly in markets like Japan, uh, and equity. Always there's something happening. But I just wanted to share with you our significant excitement at both our promoters deciding to expand our journey into the product offerings to Indian savers by committing to launch a life insurance business as well. I'm sure some of you, if not all of you, would have heard the announcement last week. But Mahindra Manulife will now look at insurance as well. And our intent is to be a very, very serious player. I think it has a lot of relevance to our business from two perspectives. Perspective number one is, I think, at the end of the day, when you go to your clients and offer them Mahindra Manulife as a product, as we get older, obviously brand recognition improves. Uh, but I think with an insurance company also carrying the same name, I think brand recognition will become that much more easier. Mahindra Manulife will be a more household name than otherwise. And the second is that as we look at especially going more retail, I think products in the insurance space, particularly in terms of protection, etc. Some of you may have read the press release. One of the intents in terms of differentiation is that as an insurance company, we plan to focus much more on protection, which I think adds a lot more potential to our relationship with you as well. So this is not a plug, by the way, to say I'm starting recruitment of partnerships on life insurance, but I think for a lot of you that sell products to customers and build wealth, if at all, I think the next two products that make sense are products that deal with health and products that deal with protection. And I think those are areas that at least the latter is something that the insurance company will focus on. So just thought I'll share that with you. We are very excited with, in some sense, having a younger brother alongside us. And we think between us, we should be able to provide a lot of value to your customers over time. So let me move to the NFO presentation, and I'm going to share screen. I just request somebody to hopefully confirm that they're able to see it once I start sharing. Yeah, is it visible?
Yeah, it's visible now.
Yeah, okay. Thank you so much. Yeah, so let me just give you one context before I present this, right? And the context is not so much an investment context, but as much as it is a business or a customer context. If at all, I would make an observation, particularly in the IFA MFD community, a lot of our book is effectively equity heavy. And there are very natural reasons for it, which I'll not get into. But the reality also is that India has traditionally been a land of fixed income savers. And to that extent, quite clearly, for each of your customers that you today do work with, there is a large pool of money that sits outside your domain, in a sense that you can distribute or intermediate on, which typically finds its way into government savings schemes, bank fixed deposits, company fixed deposits, etc. Now, As an industry, we thought we had found a solution 4 5 years ago through fixed maturity plans, because they made a lot more sense, predictability of returns, tax efficiency, etc. But ever since the tax rules changed, as you know, fixed income has been virtually a non-starter. We can all pretend that no, it's still relevant, we're still pushing, but while we look at an industry of 75 lakh crores today, and people can talk about many yardsticks. In 2007-8 it was 10 lakh crores, and in 2014 it was these lakh crores. The one asset class that really hasn't grown in this industry, especially in terms of individual AUM, has been fixed income. In fact, it's degrown. And this product, to my mind, is probably the best solution that the industry has come up with in the last few years, that probably tries to bring back some of the glory days of FMPs. Mind you, I'm not saying it is equal to or better than, but it's at least, to my mind, giving us some armory to be able to talk to our customers about a part of their portfolio that today either you are not able to provide an intermediated solution, or alternatively customers are so hung up on equity that they're not willing to look beyond. But I think in the last 6 to 9 months, given the range bound nature of markets, and for example the performance of gold and silver, which has led multi assets to become a product of focus, fixed income has somewhat entered the realm of discussion, right? And so if I was to think about from an investor standpoint, what are three pain points when it comes to investing in fixed income funds, right? The first is, in some sense, stability of returns, right? Because typically, for it to make business sense for you, sense for the customer, let's say arguably you typically sell long term bond funds or dynamic bond funds. And if you look at the way those funds have performed over the last 3 or 5 years, one thing is quite clear, is that while at the end of 3 and 5 years the returns have been all right, the journey has been pretty volatile. So the ability for a customer to counter you and say that, listen, in a bank deposit I will get 7.5%, and I know I'll get it. It's challenging to counter that with a fixed income fund in its purest sense. The second challenge is that if you wanted to counter it, which means you wanted to be a little more aware of what's happening in terms of macro, what's happening with the Fed, what's happening with interest rates, and you seek to churn, you run the risk of reinvestment, right? Because rates today were not the same as they were 1 year back. And so while you may make a very smart call on duration, when you're making that smart call, you're running a reinvestment risk. And the third, which is most important, the moment the tax treatment is identical, the argument kind of falls flat. So I mean, see, these are, I think, three pain points which has led to fixed income funds no longer being relevant selling tools for you to the customer. And that's where I think this product comes in, which essentially, in a sense, is nothing but running a dynamic view on how one should invest in fixed income funds, and complement it with 35% in arbitrage, so that you're able to provide stability in terms of returns, and you're able to do that for a reasonable medium term customer in a tax efficient way, which I'll go on to explain in the next few slides. I'm not going to, there are theoretically 30 40 slides you can make on a fixed income fund, but to my mind, the key points is what I want to highlight, because I think it's very simple and core. Is this a product you can offer to get more share of wallet of your customer? Answer is yes. Is it a superior product in terms of post-tax return to a customer for a medium-term holding period? The answer to that is yes. Third, is it coming from a manufacturer that has demonstrated, and a lot of people don't recognize this, right? A lot of people look at our equity track records and they have a judgment. They know whether we are good, bad, ugly. Uh, if you actually plotted a return chart of all the fixed income funds and liquid funds that Rahul and his team have managed, I would argue we are a top quartile fund house. And it'll be a very strong argument, especially if you just went and looked at it. So our ability to kind of tactically manage fixed income in the last few years, I would say, has been been amongst the best in the industry. And so this is the product that really seeks to, A, for the risk you're taking, provide a better return, but contradictory, or let's say complementarily, make sure that that risk is not the same risk as typically is in a conservative hybrid fund, certainly much lesser than an equity savings fund. It's an all seasons product, which means that your expectation should be that Rahul and his team must stay on the ball, remain tactical, and keep moving allocations between the various fixed income fund categories we have, so that it becomes an all should be delivered in a tax efficient format. That's really what the genesis of an income plus arbitrage fund has really been, right? And there have been a couple of launches by some of our peers in the last 3 to 6 months. Uh, I'm sure in the Q&A I will get a question, but at least this time I can answer that we are not one of the last to launch this. This is, I think, a very appropriate product that you can use to give customers that are looking for stability at some level. But more importantly, you get a solution to customers that allows you to grab a share of wallet that you otherwise are not accessing. And just think about this in a very simplistic format, right? You look at this chart, a typical debt fund over time, but in a slightly more volatile format. But a fixed income, a fixed deposit, for example, in a very straightforward format, delivers, let's say, a 7% return, and you will get 4.9% after tax, assuming the 30% tax left, right? And let me just nuance this. This is really a product that makes sense to somebody who's in the 30% tax bracket, maybe lesser to somebody who's in the 20% tax bracket, and certainly not to somebody who's in the 10% tax bracket. Now, for 1 year, this product makes no sense in a sense, right? Because it delivers exactly the same post tax return, assuming it delivers that 7%. But the magic starts after 2 years, right? So the same 7% return translates to 6.15% post tax, right? And that is, to my mind, a very, very powerful animal, because effectively it means on a post tax basis after 2 years, it is delivering you at least 2% more than typically what a FD in 2 years today is giving you. And that 2% is, I would believe, a very strong margin of safety to deal with any volatility that will come. Now, this is, as you could see from the previous slide, that was an illustration, right? And the beauty about illustrations is that आप कुछ भी कह सकते हो. मतलब वो 7% कितना रियल है, कितना एक्चुअल फैक्ट है, पता नहीं, ये तो एक्सेल शीट में कुछ भी बनता है. So let's actually look at past history in some sense, which I cannot remanufacture to suit it, right? I have to take whatever the actual data. And frankly, we were ourselves surprised by how beautifully this product can work. Just think about it very simply. What we've just taken is, let's take arbitrage funds. Nifty 50 arbitrage index represents that. You take a CRISIL composite bond index. People may argue कि normally आपने इंडेक्स ले लिया तो ठीक है, आपने सब लोएस्ट रिटर्न दे दिया. The irony is, typically in fixed income, it's far more challenging to outperform the index. So this is actually the best outcome possible. And you look at a income plus arbitrage fund that we're about to launch, which is a combination, right? 65% tactically managed in debt and 35%. Now, what you'll notice on the left hand side, very interestingly, is the gross return is lower, right? 7.4% is been the average return of the funds. The minimums have been more or less in line. The median, which is also important, in some sense, median is a much better representation of your expectation rather than average, because by and large, I think what the MFD community, for example, has demonstrated a great ability to choose the right fund houses to work with, right? So you will tend to provide returns to your customers more in line with a median than a average. Now, the beauty is that while the return on a median or an average basis on the left hand side on gross is 7.4 or 7.7%, once you combine it on a post tax basis, it automatically becomes a far superior return. And like I was explaining to you, that delta is at least a percent, right? Percent moving to a percent, 1.2%, which is, I think, a great margin of safety. But a better way of explaining that margin of safety is this. What we've basically done is taken 2 year buckets across various time frames, so nobody can accuse us कि भाई आपने October 31st को ऐसी time frame ले लिया जो looks like your product makes sense. So we've taken a wide variety of products. And also my point, friends, is not to say that this is going to be the best invention since sliced bread. I make a different point. That different point is that, and this is not necessarily just purely that we don't understand coloring, but it's quite unique that across all of these time frames, the category, so there's a duration strategy which represents long term bond funds, short duration strategy which kind of represents low duration and short term bond funds, credit risk which looks great, but as you know, given what happened in 2018 and post covid, credit risk is not easily sellable to the customer. uh, Conservative hybrid is another category, and arbitrage obviously is something that lots of people have invested in the last couple of years. And you'll find interestingly that when you plot this in terms of who's been the best return, who's been the worst return, the guy in the middle is the income plus arbitrage on the extreme right, which to my mind is very important, right? Because when you go back to my original question, what product can I offer my customer that gives that customer a proper solution to money that they're otherwise allocating to fixed deposit? Alternatively, because they have also already invested in equity extensively over the last so many years, and because markets have been range bound in the last 1 year, they are still sitting in liquid, waiting for the right time kind of thing. This kind of return, which makes it clear that the volatility of delivery of that return is by far lower than long term bond funds or short term bond funds, gives you the best answer to a product alternative, which frankly is the purest stable product, right? If I buy a 7% bank deposit, and assuming nothing happens to that bank, वो 7% तो आना ही है. So what is the product that drives returns which are closest to the median over 2, 3, 5 year time frames? This is that product, which is why I think it makes a lot of sense for you to target your customers. Just think about it. It is a way for you to increase your share of wallet with the customer, and at the same time create a bit of stability in the overall customer's portfolio of mutual funds. See, the danger sometimes what happens is that you have customers who kind of start, if they own only equity funds, they kind of associate you and their mutual fund portfolio with risk, and they associate no risk or stability with bank deposits. That this is a great product to introduce in the portfolio, so that tomorrow when you have questions with the clients where there are challenging times in equity, you will always have a product like this in that client portfolio that you can tell the client, sir, ye bhi hai, this has done pretty all right, and if you still feel anxious, maybe we can allocate more. So I think it's a very, very important product to put in some shape or form in all clients that you have that are in the 30% tax bracket. This is the uh, statutory related stuff, but I'll very quickly run through this. The idea we have is that when we are bullish, we will choose amongst our funds, and bear in mind, and you've seen that with our multi-asset fund, we will not hesitate to buy somebody else's fixed income fund if it's good. End of the day, the idea is you need to deliver to the customer the best outcome. So if you're bullish on rates, and I will not go beyond that, I will allow Rahul to talk through his current view on markets. Uh, and if we are neutral and cautious, my simple argument on this would be, I think, take any date. In fact, I don't know, but please, any of you, as of yesterday evening's NAVs, please look at our fixed income fund performance across liquid, ultra short, low duration, short, dynamic bond, and I can promise you that you will struggle to find any other fund house with the kind of quartile one, quartile two performance across time frames, which should speak to the fact that our ability to decide the right moments to be bullish or neutral or cautious is quite time tested. This is the asset allocation pattern. I'm not getting too much into detail, but a little bit, because I know this is a new product category. Not many of you would be familiar with it in some sense. But essentially, the argument is we spend about close to 65% navigating through various fixed income funds based on our view, with the balance 35% in arbitrage. Somebody would argue, guys, your arbitrage fund is not the best. That is correct. It was not the best. We've done a lot of work on the arbitrage fund in the last 3 or 4 months. You will see that in the returns if you checked. So we're quite confident that as a combination of our tactical view on navigating through fixed income and arbitrage, we'll be able to do a fair job. The rest is detail. You are familiar with all of this, so I'm not going to take much more time. I will now stop here. I can take questions on the NFO later in the Q&A. But my request to all of you who are on this call, and to all my other distribution partners that may look at this call a little later, uh, please think about this as a key ingredient to expanding your share of wallet with the customer. And there is no better time to start than now. Thank you very much.
Thank you, sir. At the fixed income team, we're also excited for this launch, and we hope that we will also manage it as diligently as we've been managing all of the fixed income funds. And with that, I just shared my screen. It's a very brief presentation on our thoughts on fixed income. I hope the screen is visible.
Yeah, it's visible. Rahul, it's
Sure.
visible.
Yeah. So most of it, so I wouldn't differ much to it. But the fact is, there has been a remarkable fall in inflation. If you look at the CPI numbers of 0.25, you probably have never seen this number ever before in India, ever before. But and hence the question always remains then, why is the 10-year still at 6.49, with despite inflation being the lowest? So if you had asked me this question, if inflation is almost close to zero, or any market participant, where would be India fixed income rate would be? The answers would definitely not have been 6.5, much lower than that. But then we also kind of tell a story around why it should be around. I mean, why it is the numbers are at 6.5, and we'll explain a bit as we go through the presentation. The second aspect of it is what is more important is the dollar rupee. This has been a bit of weakness for us for the last 1 year to 2 years. I mean, specifically in the last 1 year. And what comes as a surprise for a dollar rupee is the fact that in the last 1 year, dollar index, which measures against all of the major currencies, the DXY as we call it in our parlance, has been weak. And usually the dollar rupee, India usually sometimes appreciates, more often than not, appreciates when the DXY weakens. But this time around, along with some Asian currencies, I mean, it's not that we have only weakened. In the last 1 year, Korea, Japan, Indonesia, and India has particularly had this weakening bias. So that's kind of a bit of concerning for many people. The fact that we lost a good chance to appreciate, but then this was an Asian phenomenon. In fact, we are one of the worst performing currencies in Asia also. So that's a bit of a concern on the currency, but despite that, we remain in fine fettle in terms of the CPI coming off, and the GSEC remaining quite stable. In terms of returns, if you look at the 1 year return, the short duration funds have done well enough, and gilt has suffered in the last 2 or 3 months. But generally speaking, across funds, it has been 7% plus, and which is one aspect of fixed income that over a period of funds. I mean, if you look at the 3 years, most of it coincides to a similar number. It's just, and hence, and yet this is not as smooth as it suggests that every 3 year number is above 8. So there have been variations across in the last 3 years, but ultimately the ability to manage and create much more than this is very important in our fund that we are going to launch. So the 1 year return has been close to 7% plus, with a 3 year at 8%. Uh, yeah. So a bit about RBI policy now. Now RBI is going to have a policy in December also. The markets are a bit in a dilemma whether RBI would cut rates. Our opinion, it's very unlikely that the Reserve Bank of India cuts its rates, while the inflation has been projected much lower than RBI's estimates itself. Our thinking is that if growth, comes above 7%, people have been calling about, FY GDP growth much above 6.8%, we find it very difficult to assume that an RBI cutting rates with real growth projecting above 7%. Now that usually has never happened, where growth has trended up and RBI responds that with an RBI responds that with an rates cut. So that's something that and remember the fact that at this moment a large part of the inflation that you see has been food driven, and that may or may not sustain. That's a very difficult angle to project. The margin of errors in food inflation prediction is huge, and that's something that one need to be very aware that a 0.25 number does not enthuse people much, is because the fact that very difficult to get an handle on the 45% food inflation which is there in the basket, and services inflation in India hasn't really come off. So and while we think that RBI would probably cut rates if only the external situations, or there's a global risk of trade that emerges, that is when RBI decides to use the monetary policy. But at this moment, there is no pressing need for RBI to. That's our opinion, is that there's no pressing need for RBI to cut the rates. It's a tool that can be deferred till it is the most appropriate and needed. One of the things that we keep on, I mean, this presentation, I mean, we have been doing this conversation for long now, and this is what our North Star has always been. Every asset class has a cycle and has a very finite pool of returns. This chart measures a 3-year XRR return, in a common parlance, a 3-year SIP return generated by the gilt index. If you look at the fact that when we started lowering our duration, it had topped around 10% plus in month of February to May. That's where we had started reducing our duration. And at this moment, it has, the returns to the investors has hit the median return. And when I look at the chart, and the patterns unfortunately rhyme in a very similar fashion, that the sound wave curve, as I call it, the S curve really works in across asset classes, and so does it in fixed income. It usually drifts lower, and that is one of the reasons that we have kept a very neutral to a lower duration basket on the longer end of the fund, on the longer end like a dynamic bond fund, just because we think that that rates have probably peaked out and the best is behind us, and this returns to the investors will gradually drift lower in the long end of the curve, that is a longer bond. So the idea is to keep at the shorter end of the curve, be carry the accrual, and that's something that we have been maintaining quite consistently from February, despite RBI, I mean, before RBI started talking about it. One of the things that what we are seeing is that while the net direct collection has rose 7%, but if you look at the lower gross collection has not been great in terms of the gross. If I look at the recent CBDT numbers, they talk about the net collection, direct tax collection up 7%, but the gross collection is up only 2.5 to 3%. It is risen because the refunds have been lower across taxpayers. So there has been a rise in net tax collection, but the gross tax collection has come off. So this, which is something that we are looking at very carefully. This does not mean that the government of India will borrow more. It may just mean that it may recast some of its expenditure, but too early to say that. But what we really see at this moment, till the November numbers, as the gross tax collection having being lower than what is projected in the budget, may lead to a lower revenue number, may also lead to a lower, may also lead to lower expenditure number, but there will be no additional borrowing. That has been a very good fiscal management in terms of the current government. And hence our portfolio strategy is with the idea that we fear a duration exposure. It's kind of neutral on the long run of the curve to a bit on the lower side also. We believe that the best of the food inflation and the oil inflation and the commodity led inflation, specifically oil, is we are in the lower end, and which may just rear up an ugly head, something that we are very careful about, specifically crude as a, the crude as an asset class hasn't done well. So, and when an asset does not do well for a quite long period of time, it tends to show up in the most unexpected fashion, something that we are also very careful about. And food inflation is anybody's guess. And hence, what we're looking at is quality portfolio, shorter end of the curve, so that we run a carry. The duration impact is neutral to a slightly on the lower end. Where we run the risk is something that we say that if the US were to fall off a cliff, and which needs a rate cut by the Federal Reserve, that is where RBI would probably should intervene, and that will probably lead to a rate cut in India also and a fall in gilt. But at this moment, left alone, we think things are fine economically, and hence there's no need for a rate cut. Should there be a global risk of trade is when RBI should probably warrant a rate cut. Something, as I talked about, interesting there are two or three charts on the rate on the global side. One is that US inflation, if there may be a second inflation mountain which is happening in the US. Many of the US basket inflation, 55% of the inflation basket is higher than the 3%. Remember, they talk about a 2% inflation. And this is what exactly happened in 2021. Unnoticed, we are going to moving a similar trajectory where a large part of the inflation basket is moving to the 3% annualized growth. Something that we think merits attention. And the last point, this is important. I mean, we just thought we were just looking at charts and we thought it's very important. China has, if you look at the last number, China has just had new births of just 9 million. Globally, population growth is slowing, and at the end of it all, it should reflect in inflation. And we're talking about a very long-term story, but that's something that people need to watch about. Is there a structural fall in inflation across the world because of lower birth rates? That's something that we really need to figure out. But that's something that we thought is interesting. And globally, central bankers have been cutting rates, except Japan, and some of Japan and Taiwan stand out. But largely speaking, global central bankers maintain the cuts. And while the US, the chances of cut have decreased very dramatically in the December, but people are in a wait and watch mode at this moment. And I think this is what is being referred to across the globe, the rise in 30-year gilt rates. It is an across the globe phenomenon, something that has nothing has been reflected so far across asset classes. But as a financial market participant, I need to be aware that bond markets do signal something. It's only too late that we kind of we refer back to it. But globally, the long end of the curve or the 30-year bond yields have moved to around the move back around 3 decades back. We're talking about 98 levels now, hitting not only in UK, Japan. I mean, Japan is again back to 1998 30-year rates, and similar in the US. Now, this is something that I do not want to pass a judgment upon, but the fact is that bond markets do kind of, as I said, they kind of are is the harbinger of some news. And when I see a global rise of 30-year bonds, it's just time for all of us to just start noticing that. I don't want to draw conclusion on this one. It's just that we have this in the back of our mind when we say that would it prompt some other action somewhere because of this rise in global rates on the 30 years specifically. I leave to that for everybody's wisdom. And with those words, I end my presentation and I pass it over to Krishna. Thank you so much.
Thanks, Rahul, and good evening, everyone. I hope the screen is visible.
Yeah, it is, Krishna.
Yeah, sure. Yeah, good evening, everyone. Maybe a good day to talk on markets. We had something 52-week high almost on Nifty. I mean, actually on Nifty and almost a lifetime high on Nifty. Good set of things. I think the primary thing going on really is how the India US trade agreement plays out for now. It's something which has been a pretty highly anticipated, expected event as far as the news flow is concerned. Almost everybody is saying we are done, we are done. It's just question of maybe announcement. So hopefully anytime maybe in next 2 3 days or maybe in month end is my maximum guess. We should hear some news about it. It has its own dynamics, including the fact that till now maybe India has been among the highest taxed, not tax really, highest tariffed country. I think that let's see how that equation plays out. That has a lot of signals from not only for Indian economy but even for global financial investors, because let's not forget financial markets are a combination of everything. It's a question of earning, it's a question of multiples, and multiples do require some assessment or some assumptions about geopolitics, because that's something drives. We've seen, right, how politics influences markets in our own Indian case, and hopefully that's something look forward to. Trying to cover basically today's thought process in four cornerstones. Fundamentals, see how where we are, valuations, a liquidity angle in the market. So look at fundamentals for now. Global uncertainty is still prevailing on US, as Rahul said. Inflation is a worry on US. Worry is being exacerbated because of higher tariffs. So let's see what those numbers are, and hopefully, based on those numbers, what US Fed ends up doing to either support the growth economy by cutting rates or maybe not cutting rates at all. It's an outcome, honestly, a difficult out here, but it does have implications on financial markets. Uh, Even as a part of asset allocation worldwide, which Anthony and Rahul both spoke, interest rates do have an implication for equity asset as an asset class. So that's something to be aware of. Coming to pure play India, yeah, I think government has been clearly focused on getting their trade agreements right. We did something with UK, with UAE, and now USA, EU, Australia, etc. are basically being discussed, negotiated, and one big advantage of this trade agreement really is a real long-term picture clarity on what make in India, or what sort of manufacturing market share India can grab. Because let's not forget, some of these economies are, far bigger importers. They are far bigger, service economy vis-a-vis manufacturing. So anything they import, we do have a share to play out there that supports our own trajectory of 2.5 3% manufacturing market share of world to possibly go to 5 6 7 over this next 5 10 years. Our own macroeconomy is reasonably stable, especially if I consider that tariff related uncertainties hurting the world. Within that, global macro, I think we're doing pretty well. Fiscal monetary support is in place, and my guess is that will keep on happening, because that's a trend worldwide. Any economy which has little bit of a challenge from external environment, the government and the central bank rises to the support system. So we have the same situation here also. Crude oil price clearly a favorable advantage. Festive season has been strong, partly led by GST cut. So what only area which I will say needs to be monitored really is, is there a sustainability issue which might we'll know somewhere by January, whether the kind of superb news on India consumption, which was partly a deferred demand post August till end September kind of thing. Nobody would have bought because everybody knew that prices are going to be down. So people like to wait for low prices. At the same time, the festive season is good. Maybe wedding season is on, as per those lot of news articles. Let's possibly monitor how the season plays out. Post the wedding season, how Jan Feb plays out, and hopefully by that time we'll have this new animal called yearly ritual called budget. I'm sure we'll have something better to look forward to in budget. Earnings in Q2 has been pretty good. Actually, they've been reasonably better than expectations. I have a slide on which says where the expectations differed. Growth is strong in FY27 based on what we've seen. Uh, the core angle to entire GST also has been that as consumption rises, the corporate capex cycle will pick up, because higher the consumption, the corporates do need to create extra capacity as the capacity gets utilized. Let's look at summary of Q2 earnings. Uh, Table basically which gives revenue growth and profit growth on Nifty 500 aggregate, and then split between BFSI and non-BFSI. And within BFS, within non-BFSI, it's split between commodity companies and non-commodity companies. So if I figure on YOY profit growth, overall 15.4% profit growth for this quarter. BFSI for a change was lower at 7.3, while non-BFSI 21, and the leader of the pack really was commodities, which is cement, oil and gas, metal mining, etc. Essentially, more led by oil marketing companies, which provided the biggest delta to the earning. If you look at the same from large cap, mid cap, small cap, something very similar. Let's say in terms of the earning growth has been pretty sharp, but they had also one caveat in this mid caps. You will have a nice contribution by some of these mid and small, nice contribution by some of these oil marketing and refining companies. So that to that extent, the numbers are slightly more driven by commodity space, as shown in both the tables. But overall, we got some recovery. The some good part is, if you're talking about a 7% odd BFSI growth, and non-BFSI, non-commodity at 10%. The next year, looks good, and honestly, that's the beauty of our financial markets. We finally, all start observing things on a relative growth relative to what it was a year ago. So to that extent, we can have a nice situation. Let's look at how that's likely to play out. The chart basically which tracks from the first time, the estimates were rolled out for a given year, how they finally played out. Uh, what's likely to play out this time also is that we're talking about 17% earning growth. Looks far more reasonable, because we've got a base which has been weak. This year we might end up with maybe just about high single digit earning growth in Nifty, and to that extent, that compounding clearly helps next year. Look at liquidity variables, another factor which actually drives market. Domestic demand is strong, courtesy, everybody like you on the call. Uh, Enough investor willing to invest, enough wealth manager looking to support, those investors with their own, preferred asset allocation towards relative equity funds kind of thing, or maybe direct equity depending on the investor appetite. Global investors are a little bit on the tenterhooks right now. They're looking for comparing India vis-a-vis the world. The key concerns on India right now being relative valuation vis-a-vis the world, because I mean, let's not forget the way Indian investors, Indian fund managers look at how a sector A or sector B or large cap or mid cap, small cap are having valuation comforts or not. Globally, the people in asset allocation world really look at country level valuations. Second part is AI. AI, there are two parts. There are not too many Indian companies which directly have a presence in the AI eco chain. So to that extent, no immediate beneficiary if AI really grows. Second, coming to demographics, India with maybe the highest population in the world in terms of nearly 145 crore. We do have some issues conceptually, which says that if AI really takes over, somewhere it starts compromising on earning capability of Indian population, because AI is possibly going to do things maybe faster, maybe quicker, and perhaps far cheaper. So that's a worry from a financial market perspective on India as a country, relative valuations and AI. Corporate India promoters are raising money. That's a liquidity angle actually. New listings are simply too many. The chart on the down, which is that fresh highs, really shows how many companies. This has been taken from, I think, yesterday's Business Standard. How many companies are raising money, and what sort of amount they are raising in combination of OFS or the total fundraise. Uh, Frankly, I will be very happy, if more and more amount gets raised in total, because that is the money which goes to company. That's the money which goes to create a physical capacity for future growth. More and more OFS, unfortunately, creates no real economic, value add in the corporate level. It's more like actually investors get money. That's a little bit of a challenge, which one way to describe, which sort of fundraise is possibly better from a economy angle. In Indian context, investor leverage is creating extra liquidity, which is the proliferation of derivatives, which actually creates a much higher velocity of money, and that creates little bit more volatility as and when things go wrong. The figure on the right, again, similarly, it just splits your equity market issuance over the last 10 years period or so in terms of how fresh issuance, how the OFS and how the QIPs have happened. In ideal world, we all should look forward to more and more money on QIPs and IPOs rather than OFS, because that's what will create. Uh, from a valuation side, yes, a slide which actually captures Nifty valuation on its own standalone. So figure on the right, the top actually shows how Nifty valuations over the time cycle has played out. Today we are somewhere between 1 and 2 standard deviation vis-a-vis our own history. It's something which is gives a reasonable comfort considering the growth. So that's possibly a comfort. The figure on the two slides on the bottom, one compares Nifty valuation vis-a-vis mid cap, and one vis-a-vis small cap. The gray portion is actually the gap between the two, and that's a space which possibly conveys mid and small have been let's say richly valued vis-a-vis large. It's been going on possibly for last maybe 4 years or so period. So that's the only area which we need to understand from a asset allocation stroke fund management perspective, where is there an investor flow dynamics which is playing a role in valuations. All of us know we have this nice brackets of what kind of funds India invest in. And let's not forget, we have 100 companies large cap, around $3 trillion market cap goes to them. 150 companies mid cap, around $1 trillion goes there, and maybe remaining 1,500 odd companies, which I consider as part of investable universe, which has $1 trillion odd. The challenge is possibly more. So if you look at market side, 60% money from a market angle is into large cap, 20% into mid, and 20 into small. But the data which we generally see on analysis of flows, typically conveys a story where more money is going into mid and small cap as a percentage of total vis-a-vis large, and that's where a little bit one has to understand or integrate that investor flows do play a role in valuations being high at some point of time, and that's what we need to understand. But yeah, India relative valuations is something we need to monitor, because that's what will get the FPIs back into India. There's some good news really is that after this last 12 15 months of some sort of hibernation on Indian equity markets, where markets broadly have given a quite a low return or almost no return depending on which asset class we look at. Uh, in markets, a time correction or a price correction both make relative valuations all the way more acceptable, and that looks the case now. After being seen as richly valued, possibly markets are now fair. And yeah, to be very you know objective analysis, some of these comments are relevant because in last 12 months we've seen a lot of other economies, a lot of other markets doing exceedingly well. More so our emerging market economies, whether it's Korea, Taiwan, China, which are so-called immediate proxies in your MSCI emerging market index basket, where these four countries possibly occupy the top four weights, China, Taiwan, India, Korea, in that order. So that's something which is a nice I say placeholder for Indian markets to look forward to. So look at the SWOT analysis for India the way we see now. Stable macro is in place. Earning stability is in Q2. Downgrade cycle has reversed now. Domestic demand remains intact. Valuations are high, partly led by investor flows. Global trade issues, hopefully this question mark, rather not at the question mark, actually the entire item should get over in next couple of weeks or so, as and when the India gets its own, agreement in place. Short sectoral cycles in market, that's something, which is very evident in last, I think, 2 years. We've been highlighting even in the past about how sectoral leadership has been changing pretty fast. I think that cycle is not yet broken. One reason I can attribute to is possibly the that leverage created liquidity, which is high velocity, so money moves at much faster frequency across sectors also. From an opportunity side, yeah, a nice time correction, price correction combination makes India attractive again, and strong recovery in earnings in FY 27 I mean, any earning growth more than 15% always is to be seen as healthy. Yeah, threats as usual, possibly we'll always see in markets, and that creates opportunity for actually investing. So uncertain, volatile environment is one part, AI narrative and supply. So between this, the supply is something honestly one should really observe carefully. What this supply doing? Okay, in this more and more supply of new equities is actually rising India's market cap, but without corresponding benefit to stock prices, because some new set of companies, a new set of investors. If I'm not mistaken, I think November itself you've seen something like 15, 16 IPOs, playing out, and the pipeline which we see in newspaper or readings or broker conversations suggest we might have at least another 100 IPOs lined up for next 12 months. So that's something which can really put pressure on markets, because the same strong domestic demand for equities is finding its way into strong supply, not allowing too many stocks to participate in the overall rally. So that's mainly from my side. Happy to take any questions here.
Thank you, Krishna. Uh, yeah, we had probably longer presentation than usual because we had the launch presentation as well. But happy to take questions. They don't need to only be about the NFO. This is the monthly call, so any questions or observations about markets, any of the funds you may have observation, happy to take them. You can post them in the chat window, uh, and then we can answer them as they come along. Unusually, I think we don't have. Okay, sorry, we have one. Yeah, yeah. So this is on the NFO. Yeah, it's basically the idea of the product is to deliver. I would guess, and this is only a guesstimate, to deliver 7 to 8% over a 2 year time frame, and I'm just clarifying annualized. And the real beauty of it is really in the tax break, right? So that is really what makes the biggest compelling reason for this income plus arbitrage FOF. We have another one. What should be an asset allocation strategy for a lump sum investor? Bhaskar ji, honestly, very challenging to answer because it depends on what type of investor this is. Uh, there's this often quoted thing, rule of thumb, 100 minus your actual age should be what you put in risk assets, primarily equity. Uh, I will continue to maintain that, in equity, your products of choice should be uh, flexi cap and multi cap. If at all you had to choose a product beyond that, I would say small cap, because if you want to go outside of the diversified multi cap, flexi cap, then small cap at least continues to have the potential to deliver above average returns over the long term. Standard fund that needs to be in the client portfolio, I would argue almost as high as 15-20% should be a multi asset set of funds. And that is pretty much it. To the extent that the customer has to invest anything between, let's say, 10 to 30, 40% in fixed income, I could recommend that at least 10% of that could be in an income plus arbitrage FOF, purely because of the tax efficiency of the strategy. I just want to be clear about it. We're not trying to pretend as if it's some different strategy. We are tactically very good or anything of that sort. It's just pure and simple 12.5% tax versus 30% tax makes all the difference. So I would say that is broadly, I don't know whether that's completely answered the question, but Bhaskarji, honestly, without a color of the investor, difficult to give you a broad brush thing. But I definitely would just say that in a product ownership of a fund customer today, uh, products like multi-asset, products like income plus arbitrage FOF, in multi-asset far more than income plus arbitrage FOF, should be part of every customer's portfolio that you have. Question on from Raj, which I will defer to Rahul. Rahul, what's the view on gold, silver, and your multi-asset fund positioning? Great, because great that you asked that separate question, Raj, because we are pretty proud of our opportunism to up our gold and silver allocation, and we made some changes. So, Rahul, if you could talk about your view on gold, silver, I don't know what the time frame. I mean, but and what you've done in terms of allocation in the fund.
So in terms of fund allocation, uh, at the peak we were at 19% with bias towards silver, which was at 11%, and gold at 8%. What we have done in the month of October, and which was partially also reflected in fact sheets, is that we have reduced our positions in gold and silver from that 18% to a number which is very close to the required by the regulatory limits of 10%. But we have now shifted our bias towards, or we are gradually shifting our bias towards gold than silver in the portfolio. The idea is that the silver, I mean, uh, the silver is, as a commodity, is much more volatile, and that volatility can come into effect. So our idea is that while we're one of the largest in silvers, now we have cut down substantially on our silver exposures, and we are making it a bit more gold bias at this moment. And for
Yeah,
the
I think
moment,
that's
intend to retain that lower allocation, which is close to the regulatory limits, and we take a view on it as the situations evolve.
yeah. I think that's pretty much it. Uh, just those of you on the call, and please reach out to your RM. As we had said, every 2 or 3 months we revert from a market view to a fund deep dive. Uh, I was thinking maybe next month we can look at a deeper dive into our flexi cap and small cap fund, but would really appreciate you giving your feedback to your respective Mahindra Manulife RMs in terms of which are the two funds you would want and like a deeper dive on. So we could look to cover that in December, because obviously, given that December year end, etc., we may need to do this call somewhere around the middle of the month, which would then make market view. I mean, things obviously keep happening in the markets, but maybe we take a slight pivot and talk about some funds. So I'm thinking flexi and small, but happy to hear from you guys what that should be. So thank you very much for a patient hearing. Very happy that as our norm, we are just finishing a minute under 5, which is what we had committed. We take an hour of your time. Thank you very much for your support. Like I said, we're very excited to expand the Mahindra Manulife partnership to insurance as well. But I just call your attention to the matter at hand, which is the income plus arbitrage FOF. Like I said, it is a product that can allow you to A, create some stability on the client portfolio side, and B, increase the share of wallet you have of the customer. So please look at that opportunity. If at all, people always say, what is the great thing about doing it in an NFO? Why can't I do it on an ongoing basis? Now, this is the one product where, frankly, the time to do it is always anytime, right? So, especially in times like this where clients are looking at range bound markets, every 4 months the market retraces a new all time high. Uh, people who have 5 7 year money should keep allocating to equities, but for people who've got 2 3 year money, I think this is a great product. And so counting on a lot of your support. Every rupee matters, and I'm hoping to see a lot of you contribute. Thank you so much. Take care.
Thank you.